we decided to do a four-part series on earnings every Monday. This is part 2 regarding around earnings, and we're spreading it off in case it's like an IRA account or in case you have limited capital. We're making it into an iron condor. So obviously, if you do an iron condor, you're going to have results that are slightly less than if you did a strangle, because strangle more risk, more reward. Strangle more risk, higher probability of success. So if we spread everything off, it's going to be a little bit less risk. So the odds go down a little bit, but still, I think there's a positive return. So let's take a look.
Let's do it.
And like I said, get your helmet on for this one. During earnings announcements, traders employ strategies like undefined risk, strangles, and defined risk, like iron condors, to leverage increased volatility. Each strategy presents a different risk-reward profile. And so let's take a look. The efficient market hypothesis says that asset prices reflect all available information, including earnings data. Thus, a key question: how do earnings announcements influence a portfolio's risk-reward dynamics across various strategies, defined and undefined? How can traders optimize these strategies in an efficient market? Let's take a look. 6 years, same as we did last time. Apple, Netflix, Amazon, and Tesla. 16 delta strangle and a 16 delta strangle and a 10-16 delta iron condor. So it means in both we sold the same option. We just bought a 10 delta in the iron condor. We calculated the average P&L, the premium, the buying power, the return on capital, compared the results. Let's see what we got. And there's a lot of stuff here, I promise you. This was the deploying the strangle without anything else. If you remember, this is from last week. This is just in 6 years, looking at 4 different stocks. How does a 16 delta strangle work? Works pretty good. 78% chance of success. How does it work with the ratio of average P&L over buying power? Not bad. 0.28. How about premium collected? How about return on investment? And the return on investment, it's, again, this is over a 6-year period for each individual trade. It's okay. Tesla was actually a loser. The other ones were small winners across the board. Earnings trades, remember, have the smallest amount of edge. So just keep that in mind. Let's go to the next slide. So now what we're going to do is we're going to take a look, and we're going to look at just solely at earnings using a strangle, not defined risk, but using undefined risk. This is stuff we did last week too. We just looked at a strangle, and the win rates all stayed high. The ratio stayed high. The premium collected was decent, and the return on investment worked in Apple, but didn't work in Netflix, Amazon, and Tesla. And those numbers were net negative numbers if you just did the strangle just on earnings. So the results are very mixed for earnings. Even with a 72 or 73% probability of profit, the results are mixed. Let's go to the next slide. So for a strangle, the return on investment is potentially high, but that's when your timing is optimal. But the risk of large moves, the non-earnings periods were steady, but a little bit lower than the earnings periods, with less dramatic price action. So here we summarized everything for you in the other columns. But let's go to the next slide. So here we go to an iron condor, and this is taking a little bit of risk off the table, but we need to see how these came out in all these different periods for these particular stocks. Now remember, this was a 6-year, like very strong bull market. And these are very strong NASDAQ stocks: Apple, Netflix, Amazon, and Tesla. The win rates were fine. The ratio of P&L over buying power, that's not so good. That number came out negative. The premium collected was obviously positive, and the return on investment in all these cases was negative. Now, again, we were in a very strong bull market, and you did not get paid. Even with a high win rate, the losses wiped it out. Let's go to the next slide. So here we present the results solely on earnings data, which is a little different than all the data combined. Now, the earnings data, the return on investment's actually worse, except for Apple. So for Netflix, Amazon, and Tesla, it's actually a little bit worse. For Apple, it's positive. The win rate dropped a lot. The ratio of average P&L over buying power, this time it turned positive, which before it was negative. Much of that's due to Apple, but also Tesla and Amazon were positive. And the premium collected was all obviously positive. And the return on investment, that's the scary thing. It was good in Apple, but it was negative in the other ones. So this is a very mixed bag of tricks. When I say I don't love earnings trades, Bat, There's a reason for me when I say that. And I think you're looking at the reason. Like, oh, we just got filled at bonds. Got filled buying bonds at 4. I don't love that. But Netflix, Amazon, and Tesla over the last 8 years have had a negative return for earnings. And that's why it's tough to play those for earnings trades. And Apple, it's tough.
I totally agree. I've been very selective trading earnings, if at all, when they come out. I've been doing well with post-earnings trades, but earnings trades themselves, unless volatility is extremely high and it's very liquid, I try to avoid it.
Well, it looks like Netflix sold off a little bit post-earnings today after being up initially. The other stock I was trying to think of this morning was Taiwan Semiconductor. They had earnings and they outkicked their coverage too.
Yes.
So the earnings have not been that great this cycle at all. Let's go to the next slide. So here's where we summarize the Iron Condor, and I'm not going to read through all of this, but their return on investment is potentially high, -9% to +9%, if the timing is optional. But there's the risk of large moves, of course. And in non-earnings periods, it's a little steadier, but again, a little bit lower with less dramatic price action. Let's go next slide. So, and these are very subjective too. A Strangle can outperform an Iron Condor around earnings due to its greater benefit from implied volatility, crush, and a wider profit range. However, a Strangle carries more risk. The stock moves significantly while an Iron Condor has defined risk. It's a balance between higher potential profit and greater protection. These numbers are rough. And when we broke it down on the biggest 5 stocks like here, you can see this has been a challenge in the last 8 years with tech stocks, specifically Netflix. We picked the really tough ones, Netflix and Google. Apple's been good as it gets a little more mature. It gets a little easier. So Apple's been good, but Netflix and Amazon, those are tough. They've been tough. Avoid large moves by focusing on stocks where you don't expect massive shifts. High implied volatility often signals potential volatility, so check historical earnings reactions. This stuff's all very much common sense, but the key here is keep position sizes small to manage surprises that can move the market unpredictably during earnings. I just be careful. I mean, sometimes earnings are very attractive. Somebody wrote me this morning and said, hey, I'm just going to buy a bunch of premium before the earnings and I'll sell it. I mean, I'm going to buy it 2 weeks before and sell it out a week or 3 days or 2 days.
As volatility expands, keeps up with
as it expands. And I'm like, they're like, how does that sound as a strategy? I'm like, well, it works sometimes. It doesn't work other times. It's about a 50-50 crapshoot. Earnings are very much a crapshoot. Very much.
I think they're almost a directional play, if anything at all.
Yeah.
For them. Yeah, no, I totally agree. And we have tried to avoid in earnings stocks that aren't going to have large moves by maybe, avoiding pharmaceuticals, avoiding something that doesn't have, tight liquid markets, doing something with defined risk if markets are a little bit wider. So, there are ways to mitigate the risk without avoiding them altogether. But for me, earnings are just an event that passes in a day and, business as usual the next day. That's the way I like to look at